For the next hour, you'll be leaving the Show Me state and entering the Show Me the Money state. So stop what you're doing, grab a pen, and get ready to learn. Randy and Jake Floyd of Floyd Financial Group will be your guides for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Thank you so much. Welcome to Show Me the Money with Randy and Jake Floyd, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. My name is Jeff Shade, and as always, I'm just here to ask the questions, but of course, the words of wisdom and solid advice, they come from Randy and Jake Floyd of Floyd Financial Group, and Jake is off this week, so Randy, welcome back to the program. Good to have you with us.
Thank you. It's good to be here. We've been north to Alaska.
Yeah, I know that song you're talking about there. So you went north to Alaska, do a little salmon fishing, and you were really quite successful with that, weren't you?
We were. We probably caught, I don't know how many 100 pounds of salmon we actually caught, but it was 200 to 300 probably, and then we brought back 44 pounds of fillets with us, and
wow.
It's silver salmon is what we caught, and they are really quite tasty. The average fish was about 10 pounds.
Oh, my gosh. Now, how do you catch it? I mean, I've never been up to Alaska trying to catch salmon, but it's not fly fishing, is it? I mean, what's the method that you use?
Yeah, so we did a little bit of both. We did some fly fishing and caught some salmon that way, and then we did some just regular spin fishing. But, they kind of come up out of the ocean. We were near Bristol Bay, probably about 50 miles from there. That's the home of the deadliest catch.
Yeah, yeah, I know
series. And so we were up there, and what's interesting is they said those salmon can make that run from Bristol Bay up to where we were about 55 miles, and they'll do that in a day.
Oh my gosh, 55 miles into this thing must be flying through the water.
And let me tell you, the water up there, we were in the Naknek River, the water was probably flowing 5 miles an hour.
So you're out there in your waders boots and all that stuff doing all this fishing. How do you keep the bears away?
Well, it's interesting. The bears up there, they love to come into camp at night. We had them in the boats, and the couple of cubs in the boats at night up there a couple of times. They're really there for the salmon, though. I mean, what it was is there was some fish blood probably in the boat that they were smelling. So it's funny when you go out beyond where we were 150 miles out into the bush when we started. Mm-hmm. Then we took a float plane another 150 miles from there.
Oh my gosh.
From a place called King Salmon, and we saw bears, pretty up close and personal, but they're just really there for the fish, and they look at you and kind of just mope on down the riverbank. So
these are great big old grizzly bears too. Jake showed me a picture of one of them. I wouldn't want to be too close to one of those, but nevertheless, you're back. You're safe and sound. We're glad to have you with us here in the radio program. 44 pounds richer with salmon, so you're going to be eating good here, probably at least for the rest of the year. So Jake is off this week, Randy, and I hope he's having a great weekend. In the meantime, it's just you and me, so let's dive into what's happening in the market and in the world today. We'll start with the market right now. What are things looking like in the market these days?
Yeah, so, we'll talk a little bit about what's happening right now and maybe what's going to come in the future here. And I know Jake talks about this a lot and every week. And I know we're pretty well in agreement. There's been a lot of money printed and put into the system back through COVID, and it's been kind of hanging out in money market funds and CDs and things of that nature. And Jerome Powell probably is going to start to lower interest rates soon. So that money is going to migrate back to the market. But we've been pretty strong of late. We had that little pullback, 30, 40 days ago, I guess it was now. But we've rallied back from that. A lot of people are saying, hey, is this another dot-com bubble with, with NVIDIA and all the tech companies being pretty highly valued? The thing that we have to look back and remember is that in 2000, before the market crash, or late 1999, the S&P 500 had a price-earnings ratio of 49. Mm-hmm. And today we're closer to 19. Now let's talk about what that really means. A price-earnings ratio works this way. Let's say I have a $100 stock that earns $5 per year, okay? So you divide 5 into that $100, that gives you a price-earnings ratio of 20. So when we were looking before, we had a price-earnings ratio of 49, and here we are today at 19. So I'd say we're a long ways from the bubble effect that we had back in 2000, Plus, we're going to talk about this more later, but with AI, which, you and I have talked about, we're not always necessarily really hyped up about that. It will actually offer us in the future and is going to offer us some relief against inflation by enhancing productivity.
Yeah, I've been playing a little bit with AI. I'm amazed at some of the things that it can do. Lately, I've been playing with songs. You can tell it to write a song or sing a song for you. It'll write it about anything. I haven't done a song about Randy and Jake and Show Me the Money just yet, but I'll get that going. I'll play it on the show here for you. Anyway, so as you said, interest rates coming down here in September. Do we expect those to be here in the middle of September? When's it going to be, and by how much do you think it's going to be?
Not being here every week, I'm a little out of touch with the calendar. I think it's mid-September.
Is it? Yeah.
Is when it will be, because it's every 6 weeks. Generally, he makes that move, but I think that's right off the top of my head. But, there's speculation as to whether it will be a quarter point or whether it will be 50 basis points. And there's more and more people thinking that it may be 50 basis points due to the environment that we have, where there's a lot of people laying off people. We're also seeing consumer spending is trending down, which probably leads us to maybe a few more layoffs. And ultimately, we may get a little short-term recession that, we normally would have predicted we would have had 12 or 18 months ago.
So 25 basis points, probably pretty much for sure, could be 50 basis points, a half an interest rate point there. Do you expect there's to be more of these interest rate reductions as the year goes on, or is that going to be it?
Yeah, again, they're going to look at the data and see what happens each month. But I think a couple things. Number one, we got the election that's knocking. I mean, we're knocking on the door of that thing now coming up here,
Yeah.
I think it's going to have some effect. I think people are going to get more cautious as we get closer to the election, see who's going to win and what that means. I really think, too, that we need to have this debate between Harris and Trump so that we can look at policy. I mean, it's ridiculous that price fixing is on the agenda for the potential president of the United States.
Yeah.
I think that's about as far away from the idea of America as you could probably get.
Well, according to the calendar, we're probably about 2 months away from this election, and there are still so many questions to be answered, too. This is an interesting election. I don't think I've ever encountered one that's anything like this. So it's one of those wait-and-see situations, but hopefully things will unfold and become clearer as the days go on. Football season is right around the corner. I understand now that investors may have the opportunity to invest in an NFL team. What do you know about that?
Yeah, I don't know a bunch about it yet. It's so new, but, they're just, the NFL has to vote in favor of it, but they think they're going to. And already private equity has set aside $12 billion, to commit to this thing. So it'll be interesting to see how it plays out. Of course, that's going to come now with a whole gamut of new rules and potential, regulations and things. Always happens when something like this goes together, because somebody's afraid they're going to get aced out of it. Of course, I understand that, but, also you got to be watching and looking. That's part of investing and growing your life savings over time, right? Is to keep your head above the crowd, look around, see what's happening, and make good decisions.
Yeah, well, I kind of wonder how that's going to affect NFL teams and players and just the whole corporate culture when we're playing for stockholders as much as we are playing for our city and playing for our team and so forth. And did you say that you think that maybe there could be some more regulations that we're not used to having when it comes to something like this?
Well, I would think so for sure, because again, it's gonna breed a whole. I mean, now so let's just say it's ownership in the NFL, then it's ownership in teams. Well, now all of a sudden, now you've opened a whole can of worms, because all right, Phil. So if you throw the season this year, I'll grease your palm with another $5 million.
Sounds like the White Sox scandal or Black Sox scandal of years ago. Hey, I'm going to own part of Patrick Mahomes here. I don't know if I really agree with that at all. I don't know. It seems a little dicey as far as I'm concerned. And then, people are going to be not only rooting for their team, they want them to win, but it's almost like, gambling in that, hey, if my team wins the Super Bowl, then the value of my investment goes up. I don't know if I agree with that completely.
Well, and season to season and based on who's injured and who's not and who might be and what your backup quarterback looks like, it's going to affect how people invest, right?
Yeah, exactly. Well, it would be fun. I mean, if you're a fan of the Kansas City Chiefs, maybe you've got a stock certificate. Do they even issue stock certificates anymore that you could hang on your wall that says, I own a share of the Kansas City Chiefs?
To my knowledge, nobody does stock certificates anymore. I guess there's nothing to prevent them from doing it.
Well, I've got a stock certificate in my filing cabinet here, and it is for the Studebaker Motor Company. I think I've got some other ones like that too, but it is an actual stock certificate. Obviously, it isn't worth anything these days. Talking with Randy Floyd of Floyd Financial Group, and we're talking about current events. And I understand that there has been some pressure from the White House. This has come to my attention to suppress COVID-19 information. Do you think that's true, or what do you know about that?
Yeah, well, Zuckerberg came out and said back in the day, during the throes of COVID-19, that he had gotten pressure from the White House to censor, and I think the number, don't hold me to this, it was 20 million different postings that they censored and took off.
Right.
Now, first of all, the fact that we have the White House, here we are with the White House saying, hey, you don't publish that. Whether you agree with them or not, I mean, we want free press. We do. We want to be able to have information. The problem we have right now today is you can't trust hardly any information that you find, right?
Right. Well, it seems to be biased in some respect. Every news organization, whether it be television or radio or print or the internet, seems to have a slant on it. To me, there isn't any unbiased source of news these days. What's your opinion on that?
Now, I would agree 100%. Even people that I agree with, and even myself sometimes, I sit back and I go, okay, maybe I am a little biased in that area. But, here's the thing. Ultimately, there is the truth.
Right.
And I'd like to get to it.
That's a lot easier said than done many times. Because, as you said, there's so many influences on, different news organizations in terms of their views, and many times they can come from sponsors. They can come from any number of places. It's all about money these days. Remember Walter Cronkite? He was pretty unbiased, but wasn't there a time when he came on, and I know that you and I may be a little young for this, but he came on and he didn't agree with the Vietnam War. That was really one of the only times that I can think that a trusted anchorman like that came out with an opinion on something.
And that's the way it was.
And that's the way it was. This president does not believe that the White House, I remember it distinctly. I think he might have taken off his glasses. That might have been the Kennedy thing, but nevertheless, he had been to Vietnam, and in this reporter's opinion, something to the effect of this was a war that cannot be won. But yeah, I mean, every news organization, Fox is, certainly one way, and, CNN and some of these others are going to be completely the other way. So where do you turn for unbiased information? Well, I guess you just have to do a little critical thinking and take all the information that you can and try to figure out what is the truth. But anyway, that's the way it is here in the United States of America these days. We're talking with Randy Floyd here, Floyd Financial Group. We've been talking about current events. And if you've heard this part of the program today and you're sort of piqued or you're intrigued about how all this would affect you and your journey towards a confident retirement, we invite you to give us a call here at Floyd Financial Group and request your no-cost, no-obligation, and no-judgment Floyd Financial Group review of your retirement portfolio. Maybe you don't have a financial advisor, you're looking for some straight talk and honest answers. We'd love to sit down with you and talk about what you have and where you'd like to go with your retirement savings and help you get there. No questions off limits. What's our telephone number? 417-889-7233. You can make that call this weekend, as in right now if you want. Someone will take your name and telephone number, or you can simply leave it there. It'll take you about 60 seconds to do that. Ashley will call you back during the week and set up that appointment for you. Once again, 417-889-7233 is our telephone number. We'd love to talk to you. And as always, you can find out more about us online at FloydFinancialGroup.com. Randy, time for a break. When we come back here on Show Me the Money, we'll be talking about whether or not the president can fix inflation and more when our show continues here on 104.1 KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Randy and Jake Floyd, with Jeff Shade.
Welcome back, everybody. This is Randy. You're listening to Show Me the Money. And in this segment, we're going to be talking about Can the president really fix inflation?
Well, I don't know about that, Randy. Inflation has been a thorn in the side of a lot of presidential administrations, but how much impact does the commander-in-chief have over price growth? I don't know. If we could ask Jimmy Carter or if we could ask Gerald Ford about that, they'd probably be able to tell you. They didn't have a lot of success with inflation. So what do you think? How much influence does the president have over inflation? We'll start there.
Yeah, I think as a direct influence, he doesn't have directly that much. However, I will say this. The president as a leader of this country, and I often think about this, Jeff. You remember when you were in school and you would elect a class president?
Yeah, sure do.
And they would get up there and they would read all this stuff we're going to do. We're going to get longer recesses. We're going to get more food at lunch or whatever it was. Yeah.
No more tests. Yeah, they were doing what every politician does. They were promising things that they can in no way, shape, or form deliver.
Absolutely. And so I've thought about that many, many times. And so whenever it was time to elect class presidents and all that sort of thing, I was sitting there going, in my own mind, I'm thinking, why would you even run for that? And of course, here's the thing. We've said this before on the show that generally speaking, most people that would be qualified for the job probably don't want it. I think between the two candidates we have, there's certainly one that is better than the other one, and I won't go down that road exactly. But here's what I will say. We will not fix inflation by price fixing.
Price fixing.
I think that flies, again, directly in the face of what America was all about. That is that somebody has the big hammer to control what you and I do and even think at this point in some cases. So, the next thing after price fixing is, well, Jeff, I really don't think you need to make that much money, so we're just not going to let you. No.
Okay. Well, didn't Dick Nixon try? I don't know. I'm trying to think. Jake was telling me that because he studies history, but I think Dick Nixon tried and didn't work out very well for him.
So here's what I will say. We need a president that can lead and that people can believe in and somebody that understands business. And we need a unified approach between the president and Congress that people can say, look, let's get behind this thing. Let's fix the country. And there's some moves that they can make that can help us with inflation. And so we're going to talk a little bit about those. You're right. Jimmy Carter, Gerald Ford, they had tremendously high inflation. And we look back at ours now, recorded in 2021, 2022, we were at 9% and 7%, I think, respectively. They were at like 12 and 14% inflation. So, they had a much tougher road to hoe than we do right now. The president, through leadership, can definitely affect it if he can get Congress and the public on board. So inflation itself is basically a supply and demand problem. So when we had COVID-19 and we shut down the world and kept the government going, but shut down the rest of the world and printed all this money and put it into the system. So not only did we shove money in people's pockets, we also made it impossible for them to buy things. And so that pushes the price up. And we've talked about this on the show too, that if I'm selling watermelons or oranges or apples on the roadside, and I'm selling, as many boxes of apples as I can sell every day, why would I cut the price? I'm not going to. In fact, I'm probably going to raise the price until people say uncle and they're not going to pay the price. Then I'm going to be stuck with my apples. So supply and demand is really what drives it. So the problem is we've had a big bunch of money in the system, and we had to let the supply chain catch up because we created quite a mess when we shut the whole system down. The other thing that we need to think about is this. The government is overspending every year. When the government overspends and they have to print money, that creates inflation. So one of the things that Warren Buffett said, which I thought was brilliant, he says, I can fix the deficit in 5 minutes. So I thought this was great. Warren says, so here's what we do. We give them a 3% overage as a max. And any year that they don't make their budget, those people are no longer eligible for re-election.
Okay.
That would fix it.
Yeah.
Right?
Sure.
And pretty quickly. So, we've got to get some fiscal responsibility in this country. And that's one of the things that, it comes down to is, are we willing to do what it takes? There's another way to get out of inflation is you can grow your way out of it with increasing productivity. Mm-hmm. A lot of people think that the way you get, you fix inflation is to pay workers more. Well, not necessarily, because if you pay workers more, then the employer just has to raise the price of what they have and what they sell and what they produce to compensate for the price increase. So productivity is key, and that's the measure. That's why we have this thing called the gross domestic product, and we measure the GDP of every country on the globe to see where people are and see what their production is per capita. And still here in America, we have the most gross domestic product per capita of any country, and that's why our standard of living is still good, even though it is slipping right now.
So the question was, can the president fix inflation? Now, I understand that the Fed has a bigger influence on inflation, and the Fed is supposed to operate independently, Randy, but in reality, does the Fed work for the president? So in respect, could the president have influence on inflation because he has influence over the Fed?
Well, yeah, that would certainly be the case if he does have that. Now, here's what I would say. I think it's good that the Fed is independent. However, I think that, and I think Jerome Powell is probably a very intelligent guy, and then he has his Fed Bank chairmen, the Federal Reserve Bank chairmen, 7 of them, that most of those guys are pretty smart and have been down the road a ways, have seen, what's gone on in economies and in markets and things. And I think that they are looking at data, trying to figure out, how do we control this supply and demand thing? Because he said, well, how can the Fed and interest rates control supply and demand? Well, when it costs more to borrow money, then businesses tend to slow down their expansion and how they do business. Whereas when money is really inexpensive and cheap, people tend to go out and say, okay, let's borrow the money and let's go out and let's get speculative here and let's see if we can build a big business here. So there's a fine balance that Jerome Powell and these guys are trying to accomplish. Now, if you have, along with the Fed and them taking maybe the picture is this, the president comes along and says, okay, to the IRS, look, if we can incentivize people through some tax breaks. Also, Jerome, if you can lower interest rates and make it palatable for people to borrow money, now we can spur growth through the economy, raise our GDP, raise our productivity, raise our efficiency, and then we can help control inflation. So it's a multifaceted approach, but I do think that the leadership of the president looking at things and laying out a solid plan that makes common sense in all of those facets we just talked about, they absolutely can have a direct influence on it.
So we're saying on one hand, the president can't fix inflation, but I think if I'm hearing you correctly, what you're saying, that a president's policy could fix inflation. So there must be a difference in our journey out of inflation depending upon which president is elected here in about 2 months.
Yeah, well, if you think about it, we look back over our shoulder, and what did we have in the past 15, 18 years? We had near zero interest rates. Now, we didn't have an inflation problem until when? Until COVID.
Right.
Even though interest rates were low, people were investing in the market, people were growing their businesses, expanding their businesses. But then COVID comes along and all of a sudden we can't, we got a short supply, the supply lines are shut down, oil prices, are too high, gas is too high, diesel's too high. That created inflation because all that transportation costs got passed along. Here's what I will say. If we have President Trump elected, what do we know he will do? He will cut corporate taxes, already said he did. He will regulate the border. That's a good thing because that'll help us cut costs.
Right.
Number 3, he will let the oil companies drill. He will allow us to push oil prices back down. That will lower transportation costs, and that will help bring down inflation alone, just those facets we just talked about, because we'll reduce our cost, both for fuel and transportation, also for all the stuff that comes along with housing and listen, I'm not against people coming to America, coming to the USA. I just want them to do it legally.
Yeah, right. Well, we're pretty much all immigrants. I mean, my family came from Germany, but it was in the 1700s, something like that. I don't know how they came to this country, but yeah, I would agree with you that if you want to come to the country, you have to do it legally. There are rules in place to do that. I can't just decide that I want to go live in Canada or something like that. So I just cross the border, and when I get there, they give me a green card and say, here it is, now you can vote for the prime minister, whatever it happens to be, but it seems to be that's the way that it is here. So I'm going to step down off the soapbox here a little bit, Randy. But nevertheless, yeah, I mean, what's your opinion on that?
Well, here's the thing. So demographically, we know this. Our country is aging, and our people here, our youngsters are not having as many kids.
Right.
Demographics, labor shortages, and demand for products and services are directly governed by demographics. And so we need an expanding population. Mm-hmm. We truly do. But we want to do it within the guidelines and the legalities that help us to have control over it and manage it. One guy told me one time, he says, Randy, he said, because I used to be in management with a food company. He said, Randy, he said, anything that you measure tends to improve. Mm-hmm. I've tucked that away in the back of my mind over the years, and that is, when you measure things and you look at it, and all of a sudden you realize, wow, I'm going backwards in my fitness.
Right.
It'll make you change things, right? So if we actually had, and one of the things that Trump talking about RFK Jr., he said, I may put him in charge of policing the government. Now, we already have one of those policing units out there, but, the Chevron deference that was just repealed by the Supreme Court is going to open up opportunity for us to get rid of some of these agencies that make unilateral decisions that affect you and I, and we didn't elect those people, and we may not agree with what they stand for, right? So it's talking about how we're going to have more control over that in the future, and that our elected officials are going to be held more responsible for that, and I love it.
We're talking with Randy Floyd, Floyd Financial Group, and we're talking about whether or not the president can fix inflation. And before we continue, Randy, I'm going to talk to our listeners for just a moment. Randy just said that anything that is measured has a tendency to get better. So would you like to have your retirement plan measured? Well, if that is the case, then we invite you to call 417-889-7233 and talk to us here at Floyd Financial Group. We'd love to sit down with you, take a look at your financial plan, measure that, and see where we can make it better. Most times we can do that, but we would love to have the chance to talk to you and answer your questions. Just a casual conversation on a one-on-one basis. There is no cost for this. There is no obligation whatsoever. Entirely complimentary, and of course, there's no judgment. 417-889-7233 is our telephone number. Make that call right now. Leave your name, telephone number. Ashley will call you back during the week and set up an appointment that's convenient for you. And again, no cost, no obligation, and no judgment. Make that call this weekend. You can also find out more about us online at FloydFinancialGroup.com. It's FloydFinancialGroup.com. Ready? Let's take a break. When we come back, we're going to be talking about the Secure Act 2.0 in 2025 and beyond. When Show Me the Money continues here on 104.1 FM KSGF, where Springfield comes to talk.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Randy Floyd, Jake Floyd, and Jeff Shane.
Welcome back, everybody. This is Randy Floyd. You're listening to Show Me the Money, and in this segment, we're going to be talking about the Secure Act 2.0 in 2025.
Okay, Randy, so let's talk about that. But before we get to that, let's talk about the Secure Act in general. What is that? When did it come into effect?
Right. So the thing to think about here, this is not you've been hearing everybody talking about Trump's 2025 plan and all that. That's not it. And this is not the sunset provision on the tax breaks that Trump passed that expire in 2025. This has to do with back during COVID, because of the shape of the country and what was going on, the Secure Act was passed. And what it did was it gave people that needed to take required minimum distributions some additional options to either defer or delay or pass those RMDs off to charitable situations. So that was number one. Then number two, they came along and they changed the RMD from 70.5 to like 72. And now, of course, with the latest version, the required minimum distribution now starts at age 73 rather than that original 70.5. So there's been some additional changes that we're going to talk about here and just kind of run down. There's 4 or 5 really probably pretty important items we need to discuss.
Okay, so Secure Act 2.0 in 2025. There are some addendums and so forth. So let's get right to it. What is the first thing that is going to be changing here next year?
Yeah, so the first thing we'll talk about is the fact that 401ks in 2025, there's going to be an automatic enrollment program into 401ks. So what this is going to do, whereas before people had an option to wait a year, maybe if they wanted to sign up, or they didn't have to sign up at all, but now it's going to be mandatory that people are signed up to their 401k or 403b plan and they must contribute a minimum of 3% of their earnings. So, again, now we don't have to sign up for anything, don't have to fund anything, but they're going to make an automatic enrollment and have people save 3%, which is kind of interesting to me. I think it's good that they're trying to encourage people to save, but I just really hate it when the government dictates things.
Yeah, I was going to say, because it's not your choice anymore. What if you're, living hand to mouth, and that 3% is a big difference? But, I think that when it comes right down to it, you'll find a way to get by even without the 3%. But I'm with you. We really should have the choice on that. What about employers that do not have 401k plans? Is there any legislation coming down the pike that will force everybody to have 401ks? Do we know anything about that?
Yeah, I don't know enough about that to speak intelligently on it. I'm sure that they'll probably put a certain company's size requirement, but I don't know what that is for right now. Okay,
so auto enrollment into the 401k is coming our way in 2025. And I want to review again. Once again, you said that there are some increased catch-up contributions.
Sure. For those that are 60 to 63, they're going to give us some additional catch-up contributions we can make. Right now, if you're under age 50, you can make like $7,000 contributions. If you're over age 50, I think the new rule for 2025 is going to be an $8,000 contribution. However, with this catch-up for the 60 to 63-year-olds, it is $10,000 a year that they can make catch-up contributions through their employer-sponsored retirement plan. People are going to be able to put away like 40, 50 grand a year. If you have profit share, it could be even more than that, but $40,000 a year is going to be able to be put away pre-tax, tax-deferred for retirement plans.
Yeah, I was just thinking of, again, going backwards a little bit. We were talking about automatic enrollment into 401k plans and the fact that people are going to be forced to save. I'm surprised at the number of people that I meet or talk to who are in their 60s, maybe in their 50s, who have nothing saved for retirement because it was always an option. Now that I think about it, maybe it is a good thing to have this as a mandatory thing. Have you run into many people in your life? Of course, in your line of work with Floyd Financial Group, I'm sure most people have retirement savings. I'm certain that most of them do. But if you run into people who have very little retirement savings or don't have enough because they just weren't forced to do so.
Yeah, it's one of those things. What we see a lot of times is we will see people that come in to see us and they'll say, I'm trying to get my kids to enroll in their plan to start to save money and that sort of thing. We hear a lot about that. I also heard just the other day, read that J.P. Morgan said that there was I think they said that there was like 70,000 of their depositors, they didn't name any names obviously, that could not handle a $400 emergency, even using credit cards.
That is scary. That is way scary.
Is. And I know as we look around the countryside right now, the average, now there's the median and then there's the average, right? Mm-hmm. So the average 401k for 65-year-olds has something like $200,000 in it. And the median, though, is like $121,000.
Also, the way you were raised a little bit, too. I mean, if you were encouraged to save money as a kid, you're probably going to save it. Now, myself personally, I was encouraged to save money because grandparents went through the Depression. I still didn't save the sort of money that they did. They lived their entire lives that way, trying to save money and not spending anything. So I think partly it is the way that you were raised. But, now that I think about it, maybe a little more forced savings opportunity is not a bad thing, but I'm with you. We really should have the choice. What are some of the other things with Secure Act 2.0 in 2025 should we expect to be happening?
Yeah, so one of the things that they've talked about is they have a program out there where financial advisors have been vetted as to whether or not they are a fiduciary. And being a fiduciary is a very important thing. We here at Floyd Financial Group have been a fiduciary for many years just because we wanted to be that. So what is a fiduciary? That's someone that has to put your interest as the investor above their own. They have to, if there's any conflict anywhere, they have to disclose that conflict, and there's forms and things that have to be filled out and attested to that is the case. So the idea is that the financial advisors should be transparent as to what they're charging if they have any conflict of interest. And really, it is a very, very important thing because if you have there's two ways to invest money, Jeff. One is through what's called a registered investment advisory firm, or one is a broker-dealer. So to give people a real clear distinction, if you remember during the financial crisis back in 7, 8, and 9, Goldman Sachs was testifying before Congress because they had sold consolidated debt obligations, CDOs, and subprime mortgage-backed securities. They were selling those to the general public and betting against them. And they were doing that knowing that they were putting those clients at risk and taking profit from it. So when they had Lloyd Blankfein was the president, they had him on the witness stand, and he said, you have to remember, we were not operating as a fiduciary, we were operating as a broker-dealer.
Wow.
And we had a suitability standard, and we were well within that suitability standard. Whereas if you had a fiduciary, you would have never been put in to that position. So that's really important that the people that you talk to are actually a fiduciary. And just the fact that we're a registered investment advisory firm alone puts us in that category.
Right, and I'll explain a little bit more now. Being held to the fiduciary standard certainly means, in a nutshell, that you put your client's interest before yours. So that's what a true fiduciary is, and I think that's something that everybody should always ask for and get some proof when vetting a financial advisor. Talking about the Secure Act 2.0 in 2025 and moving forward, I also understand that there are some changes insofar as account portability, Randy.
Yeah, so from what I can see there, along with this automatic enrollment thing, you're going to be able to move your 401k plans much easier from employer to employer. Now, I will caution people on this. I don't know what these plans are always going to look like. Every plan has some wiggle room. Now, there's some basic plan designs that the 401k or 403b or 457 plan has to have, and those are supposed to be managed as on a fiduciary basis as well. However, we see wide variation in costs associated with those, and also the amount or the number or sometimes the limited amount of investment choices that are possible inside these 401ks. So sometimes it is great for you to move that 401k to your new employer. Sometimes it may not be your best option. Sometimes it might be better to have that money roll over into an IRA where you have all of the investment choices available rather than just what's inside that particular 401k plan.
We're talking with Randy Floyd of Floyd Financial Group. Glad you could join us this Saturday morning. We've been talking about the Secure Act 2.0 in 2025 moving forward and what the changes in that act are. If you're interested in our conversation, again, you want to get in and sit down with Randy and Jake, Floyd Financial Group, talk about your journey towards a confident retirement. We'd love to talk to you and answer your questions. Our telephone number, 417-889-7233. Make that call this weekend. Leave your name, telephone number. Of course, Ashley will take it down. She'll call you during the week and set up that conversation for you. Just a casual conversation. It is a no-tie zone at Floyd Financial Group, so make that call this weekend, 417-889-7233. You can also find out more about us online at floydfinancialgroup.com. Randy, we're going to take a break. When we come back here on Show Me the Money, we're going to be talking about how to build a retirement income plan, and we'll talk about which type of long-term care insurance works for you and more when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
People of the Ozarks, step away from the fishing pole and prepare to be shown the money, because we're back with more straight talk and honest answers with Randy Floyd, Jake Floyd, and Jeff Shea.
Welcome back, everybody. This is Randy Floyd. You're listening to Show Me the Money, and in this segment, we're going to be talking about how to build a retirement income plan.
And Randy, a lot of people have a target number in mind when saving for retirement. Perhaps it's $1 million by age 55. Maybe it's $4 million by their mid-60s, but having a target number is a very good start, but it doesn't tell the whole story. We have to design an income plan to get there. So let's, first of all, start by building an income plan timeline. Where do we start? What's involved with that?
Yeah, so, I often tell people in our business here and the way it works, generally we start seeing people, for the most part, probably around 50 years of age. We'll have people starting to come in and say, hey, maybe trying to look at retiring earlier. I'd like to get there by 62. Where do I start? How do I put this together? Because quite frankly, most people they go to school or they get out and they get a job and they go to work and then they have kids and then they put their kids through school and maybe through college and then they wake up one day and say, okay, so, where are we? It's kind of how it goes, right? Because you put that money into the 401k or you put money in a savings account. Probably by the time your kids are raised and all that sort of thing, you have more money than you've ever had and you're not budgeting. And so you're just going day to day. And then all of a sudden you realize, hey, I'm going to quit working one of these days. Or how about this? I'm getting sick and tired of being sick and tired.
Yep.
So I want to make sure I'm going to be able to stop this noise one of these days, right? So what happens is, when people come in and they say, okay, look, I want to see if I'm really going to be able to do this, we have to start dissecting what they have. We also have to look at their Social Security program, see if they're lucky enough still to have a pension, and look at what potential assets they have to derive an income from. Then, of course, we have to look at this thing called a budget, right? And nobody likes to hear that. In fact, most of the people that come in here, if they're in their 60s and they're still working and their kids are raised, guess what? They aren't living on a budget and they haven't thought about a budget in probably 15 or 20 years. So it's not that we're trying to put people on a budget. What we're trying to see is and make them realize what does it actually take for you to live the lifestyle that you want to live. It's a really big, important starting point.
So when we determine how much money it takes to live the lifestyle that you want to live, where do we start with that? I mean, this is really I think the building block of building a financial plan is identifying your expenses. To me, it sounds like a budget, but you're saying it's not necessarily so.
Well, it's a budget, but here's the thing. So we look at it this way. We need a bare bones budget that says this is what it takes to keep the lights on, keep gas in the car, keep everything going. And then what do we want to do for fun beyond that, right? Because when you retire, what do you want to do? Go home and sit down just sit down and just do nothing?
No.
Retirement's a lot of different things for a lot of different people. Some people want to travel a lot in the beginning. Some people don't want to travel. I have situations where the wife loves to travel and the husband will never travel. So the wife finds her some friends and she travels all the time, and that's okay. Or we have couples that love to travel together and then they travel 4 or 5 years and then they say, okay, we're done. And then they want to do something different. So when we start looking at that, we have to look at those two stages of the budget. What is our bare bones, and then what do we want to have fun on? We combine those two things, and then we come up with a number. And then that's the beginning snapshot. And one of the things that we have to think about is that's the beginning snapshot. Now we got to look forward the next 10, 20, 30 years and make the movie, right?
Right. So I think that most people really can group their expenses into 6 separate categories. And those would be, of course, housing, living expenses, expenditures such as auto purchases, travel, healthcare, and income taxes. Basically, 6 different categories. But I understand that health insurance premiums, they're going to be a little higher during the beginning of retirement, would you say, or not?
It depends on what age you are. Right now, Medicare starts at age 65. If you retire prior to that, unless you have an extension of health insurance from where you've worked, and if you work for a government agency, even a local or federal, that may be the case. You're going to have to go out to what we call the marketplace right now if you're under age 65 and buy insurance until you get there, unless you can extend. So if you are a union worker, in many cases your union will have an extension of benefits that you can do. But if you're out here working for the normal corporation and you retire ahead of age 65, you're going to have to go find some insurance. And yes, it's going to cost.
So the first thing we do is identify our expenses, and then secondly, we have to take a look at what we've got. This is almost like the 5 pillars there. We do a discovery and analysis, right?
Exactly right. So we discover what's important to people, kind of what they have to work with. Then we do the analysis process and we say, okay, so here's what we have. Here's what we've talked about budget-wise. And so let's talk about how we plan to spend this money. What's our tax picture going to look like? How much spendable money are we going to have if we collect this much? One thing that often throws people off during the income planning process is this. So right now they say, well, I'm making $150,000 a year at work. And what they forget is they're funding $20,000 a year, or maybe $25,000 in some cases, into their 401k. They're paying 7.65% for Social Security.
Right.
Maybe they have life insurance that they've been paying on out there for a long time, and then it's minus taxes. Well, maybe in retirement, in retirement you won't have a lot of those expenses. So it won't take as much money sometimes as we think. So we look at what is your bring home pay? What does your pay stub say? And
Right.
how often does that pay stub come in, right? And then we can actually calculate what people are actually spending today versus what they really, because there's a disconnect there of what they're making as a gross number and what they're actually receiving and spending. And that helps us to really bridge that gap. And then, of course, the next step is planning. How do we take all the things that you've amassed, your Social Security, your pension, your 401k, your savings, and how do we make an income stream out of that? And is there enough? And if there's not enough, how do we get to where there's enough to support the lifestyle we want in retirement?
Right, and I would imagine that also calculating your withdrawal needs, that is going to be a big equation there. So how do you go about, taking the money that you have saved and calculating withdrawal so that you will not run out of money?
Yeah, so there's the old guideline that's been out there for a long time called the 4% rule. And the 4% rule says, hey, take your gross amount that you have times 4%. So if you got $1 million, that's $40,000 a year is what you can really draw from your retirement plan and adjust that for inflation. Now, I will tell you that there's this thing that we have to discuss about that doesn't always hold water. We can't just throw caution to the wind and go out and throw all of our money into gold or Nvidia or one single stock or maybe just a few stocks. We're going to have volatility, and how markets move, we call it the sequence of returns. How did those go year to year? Because as you know, in 2007, 8, and 9, at one point the market was down 53%.
Mm-hmm.
It ended up being the low in 2008 at 38.9, I think it was. Then during COVID, we had a 32% down spike. Now, it was really short-lived. But again, we have return challenges where we don't make enough to cover what we withdraw. So we're going to have a little bit of a roller coaster ride as we go through here. And it's important to realize that we really have to be careful. We have people come in sometimes and they'll say, listen, I need to draw, based on this, I need to draw 10% per year out of my retirement account or I'm not going to be able to live. And we say, well, if you do draw 10% per year out of your retirement account, you're right. You won't have any money. You won't be able to live. We just can't historically support those kind of long-term withdrawals. So it's something we have to sit down with people and really engineer a plan. Now, I will tell you this, we can actually do a little better than the 4% rule with a properly structured portfolio and income plan.
Right, and again, that 4% rule, it's not set in stone. You have to fine-tune your assumptions as you go on, and it could be 5, 6, 7%. It could go down to 4%, but again, it just depends. Randy, you threw out the figure of $120,000, and if you're making $120,000 when it's all said and done, your net paycheck may be $95,000 that you're living on now while you're working. Is it necessarily true that you're going to spend $95,000 in retirement if that's what you were making when you were working, or should we count on it being more or even less?
Right, so there's a lot of factors that come into that. Number one, are you still making a house payment? Are you close to having your house paid off? Is it just about at the end? And sometimes it does make sense to go ahead and pay off a house. Now, many people today still have 3% interest rates on their mortgages.
Right.
So when I've got 3%, maybe I owe 50 grand on my house, I don't know that I need to pay that off because the 50 grand invested, if I make 5%, I make more money than paying off, what I had in the interest, plus I still have the money, right? When I put the money in my house, how do I get it out? Well, I have to reverse mortgage or sell it, right, to get the money back out of it. So there's a lot of ways to look at cleaning up debt, maybe to make your cash flow a lot different. Now let's talk about, let's say I owe $50,000 on the house, and let's say my house payment is $1,500 a month. Well, now all of a sudden I go, okay, from a cash flow perspective, that $50,000, if it earns 6% per year, is $3,000, and I'm spending $18,000 on my house payment. Well, maybe it makes sense to go ahead and take that extra $50,000, maybe even pay some taxes on it to get it off my plate, so that I don't have to have that extra $1,500 a month in cash flow out of my retirement savings. So there's just a lot of things to look at in how we structure income, the taxability of income. Some income is not as taxable as others sometimes. Boy, it just, dividends that people collect on certain accounts may not be taxable based on where that dividend comes from and how much it is and what their other income is. There's just a so many things to consider that it's hard to cover here, but make no mistake, if people come in and sit down with us, we're going to go through this 5-step process: discovery, analysis, planning, how we would implement the plan, and then from there, how do we monitor it and keep it current with what's going on in the world today that directly affects your finances.
And in just a moment, I'm going to give the phone number, Randy, so that people can get in and sit down with you and begin that process. But the last thing that I want to ask is, when you're working, you may get paid, once a week, bi-weekly, once a month, something like that. Once you've designed this income plan, am I going to get a check? I mean, once a week, once a month? Is it going to be direct deposited? How often do I get paid?
Sure. So we can set that up. Generally, what we do is we set it up on a monthly amount, and we can, withhold taxes for you ahead of time and make it very easy so that you get your 1099s at the end of the year and you just go file your taxes. Because most people, the bills come once a month, right? The power bill, the whatever it is, and people like to have that. Now, we do have some scenarios where on the brokerage side of things, we can pay people more often than once a month. If we need to, we can do it every 2 weeks and things like that. But we can customize a plan, and many times what we do is we look at, say we got John and Debbie here. So John, when does your Social Security check come in? Well, his birthday is the 10th, so we know it's going to be between the 10th and the 15th. And Debbie's birthday is the 25th, so it'll be between the 25th and the 30th. Well, how about if we make your retirement income check hit your bank account in the middle of the month? Now we've got cash flow all month long. So there's many, many ways to engineer it. Now, some people don't want to do that. They say, you know what? I want one big check a month. I'm going to sit down one time a month and write my bills, and that's all I want to be bothered with it because I want to be retired after that.
Well, Randy, a lot of people get a year-end bonus. I love getting a year-end bonus, a performance bonus, and let's say that I say to you, Randy, I want more than just a subscription to the Jelly of the Month Club type of thing. I'm looking for 10, 15 grand as a year-end bonus. Is that something that you can build in as well, too, or can I just call you up and say, Randy, I need a little extra cash this month?
Yeah, we can actually do either way. One of the things that we prefer to do, and I'll give you a case in point. We just had this happen. I was doing a review a couple of days ago, and this couple, they had a particular fixed index annuity contract that had locked in 23% gain for them. Mm-hmm. And so we're sitting here and we're talking about a 5% income stream. Well, they just made 4+ years of income, and that particular investment has no downside risk in this case, okay? So here we are. They may say, well, you know what? I'd like to have an extra 5% off my investment this year. Can we do that? We certainly can. So there's a lot of ways to structure that. Many times we do like to have people, if they want to take an extra trip or they want to give some money to their kids or their grandkids or whatever, if we've had a good year, yes, we can take some of that extra money, but we always look at a couple of things. Number one, where are we in the scheme of things? What was last year like? How have returns been? And secondly, what does that do to our tax picture? And does it make sense to do that for you right now?
And Randy, I promised to give the telephone number, so I'll do that right now for folks who want to get in and sit down with you, talk about a retirement income plan, get one designed that works for you individually. Our number, 417-889-7233, 417-889-7233. Now make that call this weekend. Nobody's in the office right now, but you can make that call, leave your name, telephone number. Ashley will pick it up first thing on Monday morning. She will give you a call back and set up an appointment for you to come in and sit down and have a casual conversation with Randy and or Jake at Floyd Financial Group so you can talk about your journey towards a confident retirement, which would include an income plan. No cost, no obligation, certainly no judgment, so go ahead and make that call this weekend. 417-889-7233. You can also find out more about us online at FloydFinancialGroup.com. You can make your appointment right there as well, FloydFinancialGroup.com. Randy, best laid plans certainly have a change in them sometimes, and that is the case this week. We'll be talking about the long-term care insurance and which works for you next week. So, Randy, we are glad to have you back from vacation. Welcome back, but we're out of time. So, Randy, thank you for your time, but I want to thank the fine people here in the last bastion of sanity, Springfield, Missouri, for joining us. So for Randy Floyd, I'm Jeff Shade. Have a great weekend. We'll talk to you next week with another edition of Show Me the Money right here on 104.1 FM KSGF, where Springfield comes to talk.
The information provided in the preceding program is for educational purposes only and are not intended as investment advice for any individual or entity. All information contained herein believed to be from reliable sources, however, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning offered through Floyd Financial Group, LLC, an investment advisor registered in the state of Missouri.